Thank you all for coming. So, I got into this paper several years ago, thinking about commodities, thinking about oil, and thinking about commodities in general, and especially gold. I mean, gold has been there for a very long time, and in the past, hundreds of years, it has been a store of value. But since 1990s, it has been functioning as a monetary anchor in terms of monetary policy, interest rate policy. It's also a speculative asset, as well as it is considered to be a portfolio diversifier when you put small amounts of gold into your asset allocation strategy. So this year, for example, the gold has gone up by about 35%. And it's been very puzzling to people why gold went up so much because interest rates have gone up. And there may be other reasons why gold has gone up this year is, for example, tariffs, uncertainty about the economy. And I think the bottom line is that we still don't have a very good sense of what kind of risks really matter to gold investors. Why do people hold gold? How do the futures market work? How do the options market work? I mean, we have a lot of work in say equities and bonds, but less work on gold and oil, and in particular gold. So this is what really prompted me to enter into this area, thinking about what are the stylized facts about gold market, and um, how do you understand gold? What is the link to exchange rates and treasuries? So, for example, although gold is widely regarded as a safe haven and an inflation hedge, gold's empirical behavior does not accord with that particular view because some people have shown that it's not a very good inflation hedge, it's not a safe haven, it does not move with the VIX, it does not really go up during disasters. But the thing that attracted our attention is that gold often depreciates during periods of US dollar strength, which is very, very puzzling because, as people think about US dollar, it's essentially, um, flight to safety kind of a thing during economic, downturns. And when global uncertainty is highlighted, is high, and gold would actually depreciate during those time periods rather than going up. It happened during the 2008 financial crisis period also. And also, if you look at the data well, you will see that gold has very unstable correlations with interest rates. Just like this year, interest rates went up and gold went up. And also many other macroeconomic shocks like equity or VIX or treasury bonds. You can think about other things like industrial metals. We have some other evidence in the paper. So these inconsistencies challenge many of the external models that have been developed. I mean, we don't have very good models of gold. And the simple reason why we don't have very good models of gold is because gold is kind of yieldless. It does not, spot gold is, yieldless, and yield only enters through the futures contracts because of the cost of carry and other things that establish the link between the spot and the futures prices. So this raises foundational questions about how gold prices kind of respond to economic information and perceived risk. What matters to gold investors? And that's what really this paper is all about. I mean, some stuff is simple, some stuff is complex, but in this paper, we've tried to keep the paper very simple, stylized facts so that we can understand what are the stylized facts about gold beyond what has been established. So what we are doing is we are, essentially anchoring to the existing facts in the literature that people have looked at and introduce new facts on spot gold, futures, options, and the VIX on gold. So, not there's not much work on options on gold and also VIX on gold as opposed to the equity markets. So, I mean that kind of summarizes what we really want to do. We want to start with the spot gold or the futures on gold, establish all the stylized facts, what risk matters, are there jumps in the gold market? What is the nature of the idiosyncratic, risk in this market? The way that we define idiosyncratic component of gold markets is that any variable that does not enter in the pricing kernel. So that's what we classify as idiosyncratic. So you have to use a particular model of the pricing kernel or the forcing variable, and and generally, I mean, the share of the idiosyncratic component in gold is very high. I mean, there is so much, uh, um, so essentially there are so many, you know, um, there's so many supply and demand shocks in this market that decoupling the link to the fundamentals. So I will talk about that as I proceed. So, just like I said, we want to understand gold dynamics, return volatility, which has not been considered in this market, VIX, option pricing, and the nature of downside risk premiums. Now, the important conclusion that we're going to draw is that gold fulfills its dual role as both as a reserve commodity and a financialized commodity. So why do I call it a reserve commodity? Because gold is held by central banks, is held by private institutions, is held by casinos, it's held by investors. You can get gold through Costco. I mean, but the key intuition about the reserve commodity and its link to exchange rate is that the US dollar is the primary reserve currency, whereas gold is a reserve commodity, and the link is negative. So it means that it serves as a diversifier of all the institutions and central banks that are holding US dollars. So which means that when the US dollar is depreciating, then it helps to stabilize their portfolios of the major institutional players. Hedge funds also hold gold. And it's a financialized commodity because it's in contango 99% of the time, number one. And gold has a positive rate of return, not as high compared to equity, and also it may not have bootstrap standard errors that are positive on both ends, but it is classified as a financialized commodity because as we will show that investors care about downside risk in this market, just like equity. So just like put options on equity or have negative risk premiums, the put options on gold have negative risk premiums. But what we find is that there are no negative risk premiums on the upside of gold, only on the downside. So that's telling you something about the nature of risks that matter to gold investors. Okay. Um, so I already mentioned this part that is yieldless, but this is kind of an important intuition in the paper about the reserve commodity and a financialized commodity, and then it also leads to kind of model. I mean, over here, I want to say that spot gold is yieldless. That creates a lot of problems because if you're trying to value how we have been valuing equity or bonds, I mean, and you solve an Euler equation, and you recursively solve. I mean, gold can only have a bubble value through this infinite iteration that we do, because there is no yield on gold. Um, so that creates a lot of issues with some other speculative assets as to how to value them. And um, I mean, that's the reason why we don't have a well-established model of gold, spot gold. Futures gold is fine, but spot gold is an issue, how to model them. I mean, Germain has done something by putting a floor, saying that somebody's buying jewelry, so there's a floor price. But in his model, you're switching between an investor, where the Euler equation holds, and a buyer. So it's the max. So the payoff is max of the two, and I can talk about it a little bit later, about his model. But there you're switching. So when you're trying to value options and futures, I mean, there's no way to develop a clean solution for the derivatives on gold. And also you have to make an assumption whether you are an investor or you are a buyer and when that switching is taking place. But anyway, I'll leave it here and move on. So we are
Gurdip,
advertising. Yeah.
can I ask a quick clarifying question? I think like this fact about out of the money puts on gold being expensive is very interesting, but I'm not in that literature and you are. How does it look for other commodities, like for oil? Is it implied volatility symmetric? What would be like for other
No,
important
it's not.
commodities?
I mean, there in the case of oil, only upside risk matters
Okay. And other
because,
commodities, what do you see
well,
for?
so essentially many commodities are 50% contango and 50% backwardation. So for example, if you look at copper or if you look at silver, I mean, those are the closest metals to gold. And there, first of all, you don't get, statistical significance. There is no consistency for these out of money options. And of course, we're not dealing with agricultural commodities, which may be 50-50 backwardation contango. So, but yes, I mean, I think somebody needs, okay, so I'll say one more thing, that gold and oil are probably the most liquid uh, options markets. Other markets are not very liquid, even for copper and silver. We have the data. Things have improved for weekly options. We have the weekly options data. It was there in the previous version of the paper. I mean, that's so essentially when you're using weekly options, you care about jumps. And there are many jumps in this market. For example, copper, because Donald Trump put a tariff on copper, it shot up. But there are many shocks in these markets, but the pattern for oil is different. It's not on the downside, it's on the upside. People don't like gold prices going up. They're okay with oil going down, and that is not significant generally for deep out of money options. Okay. Okay, so with this question answered, we are advertising two facts or two important uh, uh, findings in this literature, which is that the gold's most consistent driver is the US dollar index. Now, this goes beyond simply the fact that gold is denominated in US dollar. But so is oil, so is copper, so are many other zinc and other metals. But the relationship to gold is very, very special, because gold and the US dollar not only move negatively, they move asymmetrically. And and this has not been fully explored in the literature. What kind of a model would give you this asymmetry? If you only had diffusions in your model, diffusions are symmetric, it's not going to do it. So you need jumps. So that helps to motivate a jump model, basically. And also the idea is that downside risk is price, where upside risk is not price. So once you show a negative relationship, it's only coming to the downside of gold, but not the upside of gold, because gold call options, it's a flat, rate of return pattern over there. So this is a new thing that I did not know, and I did not find this in the literature, and I'll try to frame it in the context of the Yang-Chen correlations next. And now the second thing is that gold options reveal that gold functions primarily as a reserve and financialized commodity and not a safe haven commodity. And yes, we have other things from macroeconomic announcements, machine learning. I mean, they are probably, I'm not going to show everything over here, but we did a lot of dissection of different things, whether you can predict gold in the futures market, what kind of macroeconomic announcements do they respond to. But when we're looking at macroeconomic announcement, we are only looking the angle whether if you have joint strategies on gold and say dollar index, through the futures market, do they lead to higher, rate of return? So I will come back to that, and this is just to show what are the consistent drivers of gold in this market, and in particular dollar index. Okay. So this is a key thing, and I will talk about economic significance, and I'll talk about statistical significance. So the best way to handle asymmetric correlations is through the Yang-Chen and the Solnik and this French guy, I forgot his name right now. They develop models of asymmetric correlation, but the Yang-Chen method is very popular. I mean, that paper, I did not know that paper had that many citations, but it has more than 800 Web of Science citations, so it's well known. People use it. So what you do over here is that because their method allows for down and down moves and up moves between two different pairs, you have to here pair short positions in the dollar index and gold. And what you see that if you look at sigma points and you try to compare correlation in the sigma point space, say 0.25%, 0.5%, 0.71, all the way to 3 or whatever you are doing, you have to compare it to the upside. Okay, so when you compare the two, you find that the downside correlations are much stronger compared to the upside. All right. And this is, I mean, if you look at something between gold and say equity or gold and VIX, there will be no difference. Or between other determinants, and I'll come to that in a minute, especially treasury bonds and treasury yields, it's not going to be different. This is an important finding. So when you bootstrap it, your bootstrap confidence intervals are low. And also this RFS paper by Hong, Tu, and Zhou, you can do a two-sided p-value test, and that's also below 0.05. So this is the most stable relationship that you can find. Also in terms of economic magnitudes of correlation. So here, what we're doing is that we are using 22-day correlations on a daily basis, and then get the correlation based on 22 observations, and then get the time series. So the average correlation is minus 0.35. Now, if you compare this to, say, equity or VIX, those correlations are zero, basically. I mean, this number is quite high, and then I can think about one benchmark that you might know, which is the negative stock bond correlation. If you look at negative stock bond correlation, that correlation is only minus 0.09. Okay, so this is much higher than many of the things that, for example, John Campbell or other people have worked on the stock bond correlation. They almost made a paper out of this time varying correlation. I mean, they made a paper out of the negative stock bond correlation, but the average correlation is quite small. Okay, so and this is like the regression. If you have gold on the left hand side and you have dollar index on the right hand side, your R square is 14%. I mean, still it's better than 0 or 3 or 2 for other determinant. And this is a kind of an elasticity because I'm looking at in the log terms. It's basically saying that if if the dollar index, which is uh, in the case of dollar index, the reference currency is the US dollar. So it means that when the US dollar is going up, then gold returns are falling. That's what it's saying. Now I need to anchor these numbers to something like treasury bond and yields, which is there on the next page. So you can see that these correlations at the very bottom, they are insignificant because you cannot reject uh, asymmetry. I mean, if the null is symmetry, then you cannot reject asymmetry. Okay, so you can look at minus the nominal yield, you can add in the real yield, you can, and R bond is essentially your treasury bond futures return, and you have consistent data all the way to 1990. So much of our data starts in 1990 because that's when we have options data on gold. Gold market options are quite, there's a lot of activity in that market, and it's only improving. And yeah, it's true that for oil, you may have 24 futures contracts. I mean, gold may have at least 12.
So
So
let me jump in and ask a question from the chat. The question from the chat is, did the gold dollar correlation change over time?
yes,
Similar to the way, you know, the stock market bond correlation changes over
yes,
time.
yes.
And what does
So,
that tell us?
well, so this is the most stable thing that you can find. So the minimum and the maximum goes from negative to positive, but it's only positive 13% of the time. Okay, so it's the most consistent thing as opposed to the other side. You can say 62 versus 41. I mean 60 and 60 basically. So it's a very stable, relationship between the gold. Yeah, of course. I mean, things happen in every market. I mean, this is not a theorem. I mean, it's basically saying this is the empirical feature of the data. I mean, we are also getting correlations from the daily data, and then telescoping up to the monthly level, and then doing the summary statistics on the monthly correlation. Yes, you can do other things like a DCC, or you can use intraday data. I mean, you can do a lot of things, but this is the most stable thing that you can find on gold versus dollar index. Okay, so so this is basically saying that the correlation between gold and nominal yield is only 0.09, and the R square is only 4%. Okay, and this is a very important point because that allows you to establish what is the hierarchy of the effect. I mean, we have not been able to find a third variable, even if you take macroeconomic principal components from standard approaches like Gerardo, Sidney Ludwigson, and others. I mean, you don't find much correlation. I mean, you would think that macroeconomic risks are important in this market, but they don't vary. I mean, in our predictability exercises, we find that we can predict gold volatility, but just like in the stock market, I mean, markets are efficient. Even if you have the right predictors that are driven by fundamentals, you may not be able to find very very high uh, um, very high predictability R square in out of sample. But this is an important thing that I have a contrast over here, and this is a very signature result in terms of what are the drivers of the gold. Now, we also looked at quantile regressions to see this hierarchy of effects. You can see that quantile regressions allow you to go by the quantiles of the distribution of gold. And if you look at dollar index versus nominal yield, I mean, the R squares are much higher and they're more consistent compared to the nominal yield. I mean, you can also do threshold, regressions, which we also did, but they are informative, but they're not as further informative, but I think quantile regressions are useful in this particular setting, which is complementary to what I've shown. Okay. So quantile regressions, provide supportive evidence. Yang and Chen correlations provide good evidence, and we also look at the fact that gold dominates treasury yields in terms of different things, and this is kind of the German, kind of that regression that he was doing, but we add, treasury, but we add dollar index to it because we want to run and encompassing, regression. So if you don't have dollar index features, your R square is at 5% in the low interest rate states. But but if you add dollar index, it goes to 16.8%. In the high interest rate states, I mean, yields are not doing anything for gold, but over here is putting 13.5% in terms of the R square. I mean, this is not a theorem again. I mean, this is just an empirical characterization of the data. I mean, it is debatable whether the R square is high or low. And I mean, this is of course, I did not give you the summary statistics on gold and gold standard deviations. It is there in the paper, but on average, gold has been appreciating at 4% per year with a standard deviation of 15%, which is similar. I mean, the standard deviation is similar to equity, but I think equity has gone up by like 8% or 9% over the same sample period. So essentially, gold in dollar indices is, dominating treasury yields. So the effect of treasury yields only shows up in low interest rate environment where holding, treasuries become unfavorable compared to holding gold in low yield environment. All right. So with this said, I mean, let me just give you some numbers from the macroeconomic announcements, because see, one of the things that I like about macroeconomic announcements is that identification is easier because you can identify how is gold moving relative to, say, dollar index as well as the treasury market. So we have 39 macroeconomic announcements. Of course, as in the case of equities, not all macroeconomic announcements matter. Over here, we are finding that 4 are relevant, which kind of relate to inflation risk, government budget, or expenditures, and economic conditions. So in the last column, it's previous day to the next day effect. So you can see that if I take a long short strategy in the gold and dollar index divided by 2, it is still very, very significant. And in the paper, we also have only dollar index and only bond. It's basically saying that when gold is going up, then dollar index is falling. And when gold is going up, and then the return on the treasury bond is also going up over that 1 day span. And this is basically verifying at a high frequency level, just like that QJE paper, that you're getting some better identifications. Now over here you can see this is your pre-announcement drift in this column. So there's only pre-announcement drift with respect to government expenditure, and maybe in gold for investment, but nothing for FOMC. All right. And this is during the 30-minute period of your FOMC. So you're taking a snapshot of the data. Nothing is easier to understand during this FOMC that people talk about. Over here, the effect of the gold is only shows up during the FOMC, and also the bonds show up during the FOMC. But this effect is not significant, although it's high, 6.9 basis points. This is basis points. This is not percentage, okay? Because that's the kind of effects that you see even for equities. It's not very large. There's like 20 basis points. So it's basically saying that all the evidence is basically saying that dollar index matters for gold, and also treasury matter, but there is a hierarchy of effects. That's all this is doing. Now moving to, we also did I mean, everybody's doing machine learning, so we also did machine learning, and this is essentially machine learning with cross validation, elastic net. You do out of sample exercises, and keep in mind that gold is a yieldless asset as opposed to, as opposed to stocks, okay, or bonds. And and in the case of equities, people that have looked at this equity prediction have shown that ChatGPT and DeepSeek would give you about 2% out of sample R square. We are finding similar 2% R square for gold, even if it's a yieldless asset. But the key thing is that there's much stronger prediction in terms of realized volatility over the next 1 month. You can also do weekly over here, but I think we have a proliferation of results in our paper. But the key thing that we would like to highlight from this empirical evidence that it shows the centrality of volatility risk in gold prices rather than return predictability. I mean, this may also be, people have been doing this prediction in the case of equity more than maybe 25 papers or so. And still, you cannot squeeze out predictability that easily. Markets are efficient. I showed on the previous slide that gold, responds to news. But if you try to do it systematically out of sample, the same predictors like currency variables, treasury variables, macroeconomic variables, they have limited predictability, and that's just a fact in this market. I mean, whether it's a negative result or a positive result, we did what we are seeing in the data. Okay.
Gurdip, let me jump in with another question from the chat, which I neglected to ask before. So geopolitical risk, the question is, geopolitical risk exerted a lot of price pressure on gold post Russia-Ukraine war and US sanctions, while at the same time central banks loaded up on gold and de-dollarization fears heightened.
Yes.
How does that specifically elevated geopolitical risk play into your model?
Well, it's only playing through the dollar index in the model. I mean, it's not a state variable in the model. I mean, geopolitical risks, you can think about VIX, for example, or maybe there are other indicators of geopolitical risk. But the correlation between VIX and gold is very, very spotty. It does not really, maybe it's spotty because VIX may move due to other reasons. So during some periods, gold can be, we have the Hansen correlations in the paper, and to be very honest, when people say that US dollar is a safe asset, I've not seen any empirical evidence. People have written theoretical papers on it. But that evidence is mainly based on the Helen Ray's paper that in 2009, US dollar appreciated during the crisis. But if you look at a formal behavior between the US dollar and say equity and US dollar and say VIX, is not really there. and also Japan moves differently. I mean, it's not. I mean, that's the only result that I see that in the international finance, literature that people have published in top journals, but nobody has showed that it is true. But anyway, I mean, coming back over here, I mean, geopolitical risk has a broad impact on all markets: equities, VIX, gold, treasuries. I mean, is there some kind of interconnectedness where there's a consistent effect on gold? We did not see it. I mean, as a p-value on some test. So yes, anecdotally it will show up, but is it true every time? I don't think so.
Okay, let me say one more thing, which is to ask you to be a little bit aware of the time because you have
Yes,
about 20 minutes left.
yes, 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 yes. Okay, so so essentially this is the data set on options, all futures of all maturities. We have weekly options, monthly options. We also have data on silver and copper, and we try to exploit some parts of the options data. But again, sometimes including options data in model estimations can be very difficult because of non-uncentered Kalman filter versus the linear Kalman filter. But anyway, so this is the second part, which I will go through very quickly because I have already mentioned it, that we had the hypothesis on financialized gold is the following: that the average access rate of return on gold OTM puts are negative and become more negative at lower strikes. And what that really means is that if investors care about the downside of gold, they will hedge it. Okay, that's a very simple point from the equity markets. I mean, if everybody was long is long, equity, that's where their risk aversion is. Gold is not as held in the portfolios, so I think the effect would be lower for the put option risk premium, but it should show up, and that's what it is. Now, um, so if you look at the data over here, this is the pattern that we're seeing going from -19 to 40 to 63. Of course, I mean, these bootstrap standard errors are always an issue. And I know that Leoren sent me this paper like a few months ago saying he has a new paper dealing with these bootstraps, which I've not implemented, but this is your standard stationary bootstrap, circular bootstrap, anything that you do. I mean, this is a very stable result. It's not going to overturn very likely the fact that as you go deeper out of the money for gold, um, I mean, your average rate of returns are getting, access rate of returns are getting more negative. Now, and then you can do bootstrap test on the differences, and they're also significant. Now, on the other hand, you can ask the question, is it a safe haven, just like geopolitical risk question that came up? I mean, if that's true, then people will will enter into the gold call options market, and you will see some effect if people care about rising gold. And we don't really see that, and that's your safe haven hypothesis. That I mean, if over time, if it is hedging against catastrophic risk, then people will care about the upside. But the thing is that gold is also held in investors' portfolios. It's a collateral. It is held in as a reserve currency. I mean, as a reserve commodity, and but is also thought of as a hedge of bad economic conditions. But we don't see this in the data. I mean, this is basically flat. I mean, so it means what this is telling us. I mean, I think equity markets and bond markets are a very good way to think about a comparison over here, because there it's very, very clear what these rate of returns are saying. Over here, there's a lot of information whether upside risk matters to gold investors. Then they don't care about it. That's what I infer or we infer from this particular table. So just to summarize, I mean, gold is financialized because people care about the downside. Gold has a positive expected, rate of return or an average rate of return, but the bootstrap standard errors on on uh, on holding futures or spot are straddling a negative number. So, but I think the option markets are giving a very clear statement that gold is financialized. Investors don't care about risk to the upside. Now, then what we're really asking is there a model that can account for gold as an investment commodity and a safe haven commodity? I mean, and, and that's what we move into next. But I just need to. I mean, I think I've summarized the empirical results quite extensively about the dollar index link and the treasury link, and also the hierarchy between the dollar index and the treasury bonds. Okay, or the treasury yield. So we have two more tables in the paper, which I'm not going to show you. And the first table each is basically Bandoff-Nielsen, jump test. And that's saying that in the gold market, downside jumps and upside jumps are equally likely. And magnitudes are similar and frequencies are similar. Table number 9 shows evidence for idiosyncratic, for the presence of idiosyncratic risk in this market. And this risk is essentially capturing risk that cannot be explained by fundamentals, and it's large. So we would like to build a model like that, given that you cannot go from the first principles and build a model using the Euler equation, put in, for example, long-run risk or whatever thing that you are used to. You cannot really do that. I mean, think about how difficult it is to model volatility. I mean, volatility that comes out of a standard, if you think about traded volatility, it's very hard to model because you have to model equities and get the variance from there, get the variance under Q, and, derive the VIX contrast, write the option on it. And I think similarly, gold is very, very difficult to model. But so what we're going to do over here is to assume pricing kernel. This is the standard approach. And I can make jump structure more complicated, but here we are after rare influential jumps in this market. So it's got a volatility component, it's got a jump component, and so the left-hand side has zero expectation, has expectation of 1, because that's just capturing the radon nickel derivative. And from here, I'm modeling the dollar index, which is a geometrically weighted index. So once so the US dollar index is a very, very special thing on which you not only can get the spot, but you can get the futures, and options are written on the futures. So from here, it's in the appendix, we derive the dollar index based on this particular specification under theory. Now, how do you show asymmetric and inverse gold and US dollar link? So here's what we do. We say that gold has its own fundamental trend, so mu G, and this is like you're taking the drift out of the US dollar index where the US dollar is the reference, and you model an idiosyncratic component. Okay, this thing is important because when you substitute from here back into the dollar index in a relationship, you basically get a bunch of stochastic discount factors that are denominated in that are US and other countries. You can have as many countries as possible, and what will happen over here is that you're modeling this component epsilon, which is idiosyncratic risk, and we are doing a normalization so that the drift over here in the epsilon does not affect the drift in the gold. Now, this is basically a kind of a thing that's saying that, I mean, typically the dollar index will not have a drift for a very long period of time, but it will have a temporary drift. For example, dollar index has varied between say 80 and 120. Okay, it's like it's in a band, but still, when you are detrending it, I mean, that's a way to think about a model and also take the drift out of the thing, because gold will have its own drift. And then you have to go to the Q measure, okay? And I will come to that in a minute. So this is your functional equation. This is, I think, the best way of doing it. And uh, and this leads to spot, and it's in logs. If you do it in logs and let delta t go to 0, delta go to 0, you will get a simple model where you'll have a drift in gold, because this has to be positive. It will depend on the V. And then you'll have a jump component, but the jump component, uh, uh, I mean, the proportionality of the jump component, if you use Ito's lemma over here for some martingales, you will see that in the logs, it's basically saying how much is the gold jumping, depending on this parameter, which is coming from all the pricing kernels, which I have on the next page. Okay, so it's got an idiosyncratic component, it's got volatile, it's got a systematic or non-idiosyncratic component, and it's got a jump. Because when you go to the options market and try to infer all these parameters, these would be latent. You'll have to infer them from your Kalman filter. So and now, what are the sufficient conditions under which you can get this asymmetry? So if you look at the log correlations between the US dollar changes, index changes, and gold changes, you'll have a diffusion component. This term is going to be symmetric. So, and this will be proportional to the square term. So it will be negative as well. So three sufficient conditions. Elasticities have to be positive, which we show it is. And you have to have a non-degenerate US dollar factor, which means that this component is not equal to the one in the square bracket, in the parenthesis. And the same thing as a non-degenerate dollar jump factor, so that this term does not wash out. Now note that the pi's can be positive or negative, but you would imagine that from what we know about pricing kernels, that all pricing kernels are kind of positively correlated. Okay. But the reason behind this asymmetry is that you see from the options market that gold investors hedge the downside, but not the upside. So it means that when US dollar is appreciating, then gold will jump more down. I mean, that's the fact that's coming from this particular model. Of course, I mean, you can never build a tractable model of the gold through the 50 years of asset pricing that we have, because gold has no yield in it. And it's very, very difficult to lead to something analytically tractable that can also lead to option prices and futures prices. Now, with this particular structure,
So let's
yeah.
jump in with a question here. Don't real estate and Bitcoin also hedge against inflation? Shouldn't their conditions also be taken into account in gold prices?
I mean, you can. I mean, Bitcoin. I mean, Bitcoin. You're trying to explain one inexplicable variable with another inexplicable variable. Yes, I mean, you can get real estate indexes, but that's also not been very widely studied. And I don't even know what the correlation is between Bitcoin and gold. It's not very large. It may be large, but I don't know. I can check it,
Okay.
but it's a short data.
And then one other question from Liurin. Is the downside versus upside difference similar to that for SPX options?
I mean, SPX is symmetric. You mean the gold between gold and equity? Is that what it is?
Well, I'll let Liurin clarify his question. I'm not sure
Okay, so
what he's asking.
I thought the SPX of I don't know gold options. This is a very interesting paper. For SPX options, I thought the skew is super like one-sided, right? You have
Yeah,
a
negative,
put
yeah.
skew.
Yeah.
So people really also investors hedge market crash. They don't hedge going up. So
Yes, yes.
in that argument, I feel like it's similar. I wonder, Yeah.
Well, yeah, I
I'm not
mean,
sure they're connected in a sense.
well,
I'm just
yeah, I mean,
modeling.
so essentially, your point is a little bit different. If you're, see, I mean, one way of thinking about this is that, yes, I mean, the people only hedge the downside over there, and we are hedging the gold downside over here as well. So, but I think the difference with the equity is that if you have a very critical mass of short investors in the equity market, they will hedge the upside. Okay, and that's the U in the pricing kernel. It's an asymmetric U, but I think very likely the pricing kernel of the gold market is going to be downward sloping. It's not going to have an asymmetric U. That's my guess. I mean, of course, I did not extract the um, the pricing kernel of the gold market. Maybe it's not even relevant because you need to do so many hooplas in order to get this in this particular setting. Okay.
Okay, let me say one more administrative thing. It would be great if you could finish up in about 5 minutes.
Yes, yes. So, so what we are really doing over here is that this will lead to because futures will have yield on it, so you can use the kind of heat gyro modeling framework to get the futures contracts, and then based on that you can get option. So, and after that you need measurement equations, and we are using measurement equations from the futures contract to identify the risk premium parameters and the latent variables. We're using volatilities and the VIX in there, so option prices are showing up. We are not using uncentered Kalman filter and putting all options over here because we wanted to keep out of money options for an out of sample test. So we do that, we estimate the model, and this is what we really find. I should say that this is when, I mean, the Kalman filtering, we're still working on. I mean, you need millions and millions of combinations, even billions. So we're not fully done, but this is from a set that is giving us the lowest log likelihood right now among all the models, but it does not mean that we cannot find a better log likelihoods. So if this is basically saying that compared to the standard stochastic volatility model and stochastic volatility model with idiosyncratic risk and jumps, I mean, the full model is doing well. So it means that idiosyncratic risks are important in this market in terms of getting better volatility input. I mean, jumps will matter for out of money options, and you're doing a Diebold Marino over here. And it's basically saying that if you're looking at root mean square errors are typically higher than absolute pricing error. Okay, so this you may think that this is large. Yes, it's large, but in absolute pricing error terms, this will be much smaller. So when you look at volatilities, then I mean these are models. I mean, and I would show you the picture of the VIX, but this is what we are really finding, and this is for volatility is all out of sample because we are not using actual strike specific options in the Kalman filter. Okay, I mean many people just put everything in there and then get it, you will improve it, but anyway, I mean this is your performance for in terms of strikes across puts and options, across puts and calls. Okay, and R squared, when if you run a regression of the actual value versus model value, you're getting high R squares. I mean, of course, I mean the issue over here is what's a benchmark. I mean, there's never a true benchmark. Um, of course, black shows would be a benchmark, but there the R square would be 0. So R square is already standardized. So if you're getting high R squares like this, then it's a reasonable way to think that you're matching a large amount of the data. But we are still working on getting the best possible log likelihood for this particular model. So we have 3 tables that deal with this option, then they will be revised as we move forward. The first 9 tables are not going to change. Okay, so now the question is, can you use this model to figure out risk premium? So what we are really interested in are the risk premiums on put options negative from the model, because you have P characteristic function and you have Q characteristic function. You can derive it in this particular setting on the futures. You can also derive log volatility under P and Q. And this is your volatility risk premium based on the data. And this is from the model, and this is the futures, 3.3 versus 3.7 from the model. Yes, of course, I mean, these may change as we move forward. And these are the averages from the time series. So it's basically telling you that as an additional dimension of the data, it's doing okay, all right? Now, finally, I just wanted to show you some plot of the VIX. I mean, as you can see that after 1999, this model is doing better. But prior to 1999, this model had some flatness. And it's like hitting the lower bound on the constraints that we are putting. So we have to check this, why this is happening, why I did not track it well. I'm thinking that it has to do with the volatilities, V and I, especially the idiosyncratic component. And but after that this model is doing okay in terms of the VIX. So it's matching the Q, it's matching the P, it's matching certain features of the data, and that's all what we can hope for. I think we have come a long way in our literature, trying to understand options and also related data. So we did not. I mean, in some sense, it has a very modest goal of thinking about economic drivers. I mean, what do we know about gold? I mean, what is the textbook behavior that you can think of? What affects gold? Can you build an economically consistent model of gold? How do you implement these models? I mean, and how do you show that gold futures are in contango? Because many people that have looked at this, I mean, they did not go far enough to show that gold is 99% in contango because it's an investment asset. I mean, S&P 500 is 99 or 100% in contango. But puzzlingly, VIX futures are also in contango, even though the VIX futures on equity are negatively correlated with S&P 500. So that's another puzzle that I've looked at. Why are the VIX futures in contango? But anyway, I mean, here gold is in contango, and we have implemented a jump diffusion model over here. We are still thinking that our tentative estimates are saying that this is a good way to proceed, to think about idiosyncratic risk, systematic risk, and jumps in this particular market. Maybe there are better ways of doing it, but we have not figured out a better way. I'll take questions.
Great, Gurdip. Thanks very much. If you have any questions, please feel free to unmute yourself and use your microphone to ask them.
Looks like there are no questions. So with this, thank you for coming to the first VDW of the season. In 2 weeks, we will rejoin, and Andres Trolle and Pierre Colin Dufresne will tell us about their new work on credit versus equity options. Thank you very much.
Thank you very much for having me. This was such a pleasure. Thank you.
Thank you, Gurdip. Thank you very much.